Okay, great. Well, I will kick things off. Hi, everyone. I'm Julienne Cassarino. I'm here with Ian Green and Christine. We're the virtual bank conference team. Thank you so much for joining us today. We're thrilled that you're here. We've got 2 half days of presentations. We're thrilled to be presenting 10 banks, each with a really interesting investment story to tell, and 2 keynote speakers. One today speaking on the cannabis industry and tomorrow on interest rate fair value marks. I just wanted to point out that on our website are one-page summaries of financial statistics that I put together for each of the presenting banks. We'll go over some of the details more tomorrow, but I wanted to point out that there are some fair value marks for what's available for the banks. There's held to maturity marks, which are largely taken from call report data, and then full asset and liability fair value marks if available, as well as if we were to mark the AOCI back up. So in essence, no fair value marks. So I just wanted to point that out, that was there. Thank you.
Great. So just a little housekeeping. Each bank will give their presentation, followed by a Q&A period. We encourage everyone to ask questions. To ask a question, please use the Q&A box in the Zoom window. Julie and I will curate those questions and ask them aloud to the presenter. If we don't get to your question, we will do our best to send these on to the presenters for follow-up. Now, the Q&A box will be active and live throughout the presentation, so you don't have to wait to the end. If something pops in your mind, put the question and answer, and we hope to get to as many questions as we can. So I think we'll get started with our first speaker for the day. We'd like to welcome Sundie Seefried. She's the CEO of Safe Harbor Financial. It's a fintech company that partners with banks to find banking solutions for firms in the cannabis industry. Sundie started Safe Harbor as a business line within a credit union. In 2021, Safe Harbor was carved out, and in 2022 became a publicly traded corporation. Sundie's a banker that runs a fintech, which is often different from a tech person who tries to run a fintech. So she knows what she's talking about from a banking perspective. Let's welcome her as she walks our investors and banker audience through this relatively new business opportunity of banking for cannabis. Sundie, we'll turn it over to you. Thank you.
Thank you very much. It's good to be here today, and I'll go ahead and share my screen, but it's disabled if you wouldn't mind giving me that.
How's that?
Okay, I should be there.
Actually, just before you start, Ian, we can hide the non-video just so we highlight Sundie.
Okay, we just... All right, can we see the presentation okay?
Yes, it looks good.
All right, great. So first, let me say that I'm going to be using our investor deck just simply because of our public status at this point in time, but I will focus more today on those things of interest to specific investors and banking so that you will understand. So if I don't touch on everything, the presentation is available, but we'll focus on a little more on the risk of the market and what we face in terms of regulators and controls and how we got to where we are today. So we are a fintech platform, but we were actually decoupled from a credit union situation. We started our fintech platform, actually not knowing that we were going to head to a fintech platform way back in 2015 when we first started looking at the market. And what does that market look like? Well, first of all, Safe Harbor is presently, we're located in Denver, Colorado, and we have an office in Little Rock, the technology office that actually manages a lot of the fintech platform and does our lending to the industry. So we're very, very much focused on the cannabis industry. We don't do anything outside the cannabis industry. However, we are prepared for other high-risk markets. And to give you an idea of what another high-risk market would look like, it would be something like psilocybin coming in, which is also a very much controlled substance and also going to have the same issues that we find in the cannabis industry. And again, I apologize. I just got back from travel and I must have picked something up on the plane yesterday. So if I have a coughing fit, I just want to give you that heads up. So the industry, when we started, this gives you kind of an overview of where we think the industry stands at this point in time. But when we started in 2014 with our research as a financial institution, we actually only had 2 states that were legalized medicinal and adult use, and 11 states that were just medicinally legalized states. So that's how small the market was. And in Colorado, because we were based in Colorado and they had legalized adult use in 2014, there was a real public safety issue in terms of being able to get that cash into the system. And wherever you went, there were companies who were carrying backpacks full of cash to make payments on their electric bills or their taxes or whatever the case may be, where they need to make payments. And so we, as a credit union, were chartered to serve the underserved and the unbanked. So it made sense to us to take a look at this as a credit union and say, what can we do to help Colorado out? And I really, at that point in time, went to the regulators and had this conversation thinking they would just shake their head no and not to go down that. But the governor was very active at that point in time and definitely wanted somebody to get the money into the system and improve the safety in the community. So that's how we got started. And when I talked to the regulator right from the very beginning, and there was a lot of the unknowns. Nobody knew anything about the cannabis industry at that point in time because they were all operating under the radar. They were federally illegal then. They are still federally illegal at this point in time, but there was no transparency because nobody wanted to raise their hand and say, I'm in the cannabis business, come look at me. So we went into this not knowing what our total risk was in terms of banking the industry itself, nor what the companies looked like. And I think that was the biggest surprise altogether. When we actually started talking to those companies and understanding the complexity, we had to learn the industry in order to mitigate the risks. So it was from day one trial and error. As you know, FinCEN had issued the guidance in 2014 that said, if you specifically want to serve the marijuana industry, here's how you have to do it. And it was vague to some extent, but not to the extent that if you were already in banking and you understood BSA to some extent, you understood that this was a total bank secrecy BSA program and that everything was focused on understanding how to put those monies from the industry into the system legitimately and forcing transparency and accountability from those companies. So that's what we focused on. That was the risk that we put front and center because at this point in time, as you know, officers and directors of financial institutions are subject to prosecution as money launderers as long as this is federally illegal or a substance, a drug classification of a Schedule I at the federal level. However, we of course have that discrepancy between state actions and federal actions. I didn't do this haphazardly in terms of not knowing what the repercussions were, even though I will tell you I've been a banker since 1983, and I knew that there were serious risks involved here. I actually did a lot of homework speaking with third parties. I went to DC and met with NCUA, our insurer at the credit union at that point in time. I met with all the other federal agencies. I made sure that we were so transparent that if they didn't want us in the business, if they didn't want the accountability and the transparency, that they needed to tell us sooner than later, because as you know, the reputation risk of entering a market and then having to leave a market is not good for the financial institution. All of the information that I gathered during my research was that they wanted the accountability. They wanted the money in the system. If you go right down to the fact on the reporting, and that's what the FinCEN guidance of 2014 is all about, is reporting properly and allowing FinCEN to be able to track the money moving into the system and throughout the nation in terms of how this money moves. If you think about the number of reports that they ask us to produce on a regular basis, they also needed to learn what a legalized market looks like. So while I sat in front of the DEA at some point in time, and they're not happy that we were banking the marijuana industry, as we called it at that point in time, they also knew that they liked the reporting. They liked understanding the industry. The same thing was with the regulators. They didn't want us necessarily to take that risk as a financial institution, but they wanted to understand the industry. They couldn't allow us to bank what they didn't understand. So it was a learning experience. The regulator said right from the very beginning, we'll walk through this side by side and you'll keep us very informed. So it was truly a meet with the regulators and do presentations and help them understand the market literally pretty much every 90 days until they were comfortable. And if you recall, the guidance was just that. You could have the FinCEN guidance handed out to 10 different financial institutions and get 10 different interpretations. So we spent a great deal of time debating the parameters of that guidance and to what extent it would be that we had to mitigate the risks. And right down to, as an example, the regulators came in one of their very first times and said, your bankers, their service representatives, need to go out on site to every dispensary and do a risk rating of that dispensary. And I said, well, there's no way. We had already at that point in time over 200 dispensaries that we were managing with maybe 5 bankers. And we talked about the fact that as bankers at that point in time, our job was to keep our eyes on the money. And according to FinCEN, the state's job was to keep their eyes on the product and the licensing. So that was one of the very first risks that we had to say, you have to separate what the bank's role is in this versus what the state's role is in this. And if FinCEN says, as the state can watch the licensing, we just need to work in conjunction with whatever the state is doing to make sure that between the state watching the product and the state watching the licensing, we watch the licensing in the state to make sure that they were legitimate businesses. And that is to this day the same thing, and I don't ever see that going away. If a license is not being renewed, or it's delayed, or it's canceled, those are the major red flags at that point in time for us to take action. So you have to think about, if we're monitoring 5,000 or 6,000 licenses at any given time, we have to understand where each of our clients are coming from. So that's the complexity. People often say, there are 38 states here, as you can see, medical and legal use. And one of the big fear-mongering factors from the very beginning was, as a banker, I need to know every regulation in those 38 states. That's not necessarily true. I need to understand, as the banker, the cannabis industry in each of those states. I need to understand that those states have separate licensing, which came to the fact that we started creating mitigating strategies, like each bank account for each state needs to be separated because of that licensing factor. And we can always go back to Colorado and talk to that regulator at the state level about the funds in that account versus the funds in the Nevada account. And our intent was never to actually grow the company on a national level, but when our clients started getting banking, they started growing and getting licenses in other states. And that comes back to the risk again of bank secrecy. Can you bank half a company? And it was my take that I could not bank half a company and actually fulfill the BSA obligations. So that's how we ended up banking across the country. So 70,000 businesses. And if you're already in the banking industry, you know that when I'm talking about the businesses, we're talking about not only the licensed businesses, we are talking about the ancillary service providers to the industry. We found out immediately as we started offering banking to the industry and they started writing checks on the account to their vendors, those vendors started getting shut down at their particular financial institutions. So they had no way to process the funds. So we were forced into going into a monitoring process. Risk number 2 that I really found was a big risk was setting up the ancillary service providers. And why is that? Because I have always said that if any type of money laundering or illicit activity was going to go on, it was probably going to happen through those ancillary accounts more so than the regulated accounts. And that's because there are a lot of touch points in validating cash on the regulated level with regulated institutions with licenses from each state. But nobody's really watching the ancillary accounts. And we talk about the complexity, and you think that you've got multi-state operators here are doing business in 6, 7, 8, 15 different states now. How do you monitor all those different accounts under one banker, or make sure that money isn't being commingled between states, or that they're following the rules? And there were no rules at that time. So the second risk, of course, was, the complexity of the ancillary companies and setting that up. What we're finding today is that a lot of financial institutions still, while they are reducing the risk of ancillary service providers by moving them out of the financial institution, if they're taking them and they don't know that they're taking and banking those companies, they're not monitoring them to an extent that would protect the financial institution on a regulatory environment. So 70,000 plus potential accounts are out there, but the industry only continues to grow. And this includes new licensing. So while we only had medicinal or adult use, and we had vertical integration where they had manufacturing licenses, and then we got distribution licenses, and now they're getting social club licenses. So every time you turn around, there is a different state who's offering a different type of license. So as an emerging market, it's continually changing and still emerging. So it's not changing as fast as it was from 2015 probably till 2020, but it is continuing to change. And the legalization, as I said, started with 2 states on adult use and 11 on medicinal, and we're now at 38. That legalization really ramped up during COVID. And the reason it ramped up during COVID was because the states that had a solid legal program, like Colorado and Washington State, those states were realizing the benefit of the cannabis industry taxes. And they actually, even while at first here in Colorado, the governor had not put them on the essential business, within 2 hours of making that decision, the lines were out the doors at the cannabis dispensaries, and the governor changed his mind at that point in time and said, well, if we might need to view this like a liquor store and allow them to operate during COVID as an essential business. And that's when we really started seeing a lot of the legalization move faster, right after COVID, after we saw those taxation dollars actually benefit each of the states that was implementing. The problem still is that the states do things differently. They have different types of licenses, and that really does make it difficult for some of the mom and pops who come in the door who are not vertically integrated. The larger the industry gets, the more vertical integration and control over the supply chain becomes to those companies in order for long-term survival and not to fall into a dominated market by just the multi-state operators. So we're seeing that actually get addressed in the market at this point in time. In terms of sales, it's a huge market at 46 billion. And these are, estimates that were made before full legalization has been realized in a lot of these states. Standing up a legalized program takes a great deal of time. And what we do is we actually move to those states who are actually legalizing at any given point. We talk to them in advance, whether it's the regulators or it's the state officials or it's the law enforcement at the attorney general level. We're educating as they go along so that they would know the impact on the financial system as they move into legalization, so that they understand there's a lot of banking available. I think there's a misconception out there that there's no banking available to the industry. There is banking available. It's just not that easy to find. And it really goes back to that first risk I told you, that if you get into it and you don't do it right on the BSA level and you have to move out of it, you don't necessarily want to put that out there in front of everybody. But a lot of the ground has been cut for financial institutions at this point in time based upon the fact that we went through a lot of education in the past, and we're still doing a lot of education with regulators. So as we built the program, remember, we built it from a not-for-profit perspective, from a credit union perspective, and we were trying to do the right thing, for the industry and the community, not necessarily create a potential public company that has happened at this point in time. So legalization continues to move forward, and the acceptance from the American public continues to move forward. And what we're seeing is that the industry is being viewed very much like the alcohol industry and tobacco industry. And that even proved itself out during COVID when those companies thrived during difficult times. And so we consider it a portfolio that's recession resilient. Nothing's recession proof, but recession resilient, where it didn't seem to wane. The other misconception there is that sales are down in the industry. Well, it's not necessarily from what we're seeing, and we've banked over $20 billion in cannabis-related funds at this point in time over the last 9 years. So we have a pretty good idea of what we're seeing at the company level because we're touching base with these companies on a quarterly basis. It's not necessarily that sales are down, but if you take the thought of everybody used to fly to Colorado to get their cannabis and to go on vacation and to see how that experiment was going in Colorado, now they don't have to fly to Colorado when they have 38 states in which this is available. So we're seeing the market just spread out. And that's what's causing a lot of the multi-state operator integration into the industry and success, because now they're starting to realize that they have to grow with the volume across the country, not just in one state. And that we'll talk a little bit later about the legalization and the rescheduling and SAFE, but that kind of gives you an idea of the complexity of the market. I guess if I wanted to give you one conclusion here is that it continues to be an emerging market, and that your BSA staff or anybody who's managing the program needs to understand the history of where it's come from to avoid any of those risks, and also be the curious type who's going to be watching those risks that continue to emerge and move with the market. So this is why when they talk about financial institutions not wanting to enter the market, they're not necessarily wanting to put the resources to develop along with the market a program to protect the financial institution. As financial institutions, we all know the extent of bank secrecy and the potential fines that are assessed if we don't do that correctly. Again, it's never been an easy path, and the risks have always been there. And we faced a lot of things right down with FinCEN and having to refile thousands and thousands of reports because of one specific error that was present. And we found it in our own internal audit and self-reported, worked with FinCEN. But again, we were afforded the fact as a front runner that we were working and being very transparent with the regulators all the way through, so as not to make them nervous and to let them understand that we wanted to do this correct as we were helping to set the standards. So as I talked about the risks, some of the biggest ones here, the no safe harbor, this is where you're going to see that actually legislation is going to assist the financial institutions. I think there's this misconception that the SAFER or the Safe Banking Act is all about the actual cannabis industry, but it is really about the banking. And I think the first thing that SAFE will do is take care of this prosecution. But while it takes care of the prosecution risk, it doesn't remove the BSA risk. That doesn't change. Now, in these legislative packages going for consideration, it does talk about reviewing bank secrecy and reviewing the requirements, but I don't think that the market is quite there to remove the risk of BSA and potential prosecution on that end, because of the fact that the black market or the gray market or the illicit market continues to operate in plain sight. You actually have all these licensed businesses out there, and what we're seeing at this point in time, that right next to a legalized cultivation, another cultivation will open and it doesn't have any sort of license at all. So again, the banking factor, in my opinion, is going to be the one thing that starts separating the illicit from the legalized market and assisting law enforcement and actually pinpointing those accounts that shouldn't be in the system, that should be removed, those licenses that don't exist. So in the very end, when there is sufficient banking for the industry, law enforcement should be able to look at those who don't have a bank account, or in the fact that we're terminating bank accounts. Why are we terminating? The most important report we probably file on suspicious activities are those that where we have suspicious activity or those that we're terminating. And there's a lot of fear surrounding bank secrecy that, if it gets mixed into your funds, that in itself is a violation. But if you know bank secrecy and the real risk is not finding it. So while a good bank secrecy mitigating strategy is to make sure you don't allow those illicit businesses into the door with extensive due diligence and knowing your company, KYC, the better part of bank secrecy is monitoring those accounts for activity afterwards and being able to pinpoint potential illicit activity, and then working with law enforcement to see how they want to manage it. And I will say that those reports have been, I would consider, misunderstood for years at this point in time, which is one of the reasons we work with the attorneys generals to make sure they understand what reports they really ought to be looking at. And if we get an account where there's suspicious activity, we go into the education process and work with the state and the Attorney General's office to say, how do you want to manage this? Are you looking at this account? And do we keep this open? So again, this has been a learning experience all the way from the very beginning for all levels of, and the federal agencies have not always been the fastest agencies to move into action here, because they're not necessarily wanting to touch a Schedule I drug that's illegal at the federal level. So we've talked a lot about the barriers already and the complexity, and it continues to be a high-risk business. I often speak at conferences, and when I'm in the room in front of a lot of bankers, I'll ask them, how many of you are already banking money service businesses, casinos or check cashing facilities, or even liquor stores, cash-intensive businesses? And out of, say, 100, I may get 6 hands that actually are raised doing money service businesses because of the BSA responsibility associated with high-risk, cash-intensive businesses. And so I usually say, well, you're about 65% there. In fact, we didn't serve money service businesses, and regulators, we kind of saw the correlation there very early in BSA, and they didn't want us to touch money service businesses at the credit union. But by the time we finished putting the entire cannabis program together, they realized that money service businesses fell right into line with cannabis. It's just a matter of focusing on each different type of market. If you do a Google search, because everybody seems to think if we deschedule or reschedule that cannabis is going to have great access to banking all of a sudden. Well, I would say that if you do a Google search on money service businesses and banking, you will see that there are a lot of issues for those companies being able to have access to banking and retain that relationship long-term because of the complexities of the cash-intensive nature and monitoring and the expense associated with BSA. So that's what makes us unique when we're working with our financial institution. We become that cannabis compliance arm between the industry and the financial institution. I will show you how that looks. So here is, I don't know how to get rid of that thing, sorry. Here is what our fintech model looks like. And if you look over here, we have our financial institution partners on this side with whom we partner. We are not the depository. We do not have deposits on our balance sheet. We do not have lending on our balance sheet. We work closely with the financial institution on their balance sheet and their appetite for the cannabis industry. But what we're finding now is we're getting in talking with our regional banks that the bank over here doesn't want to deal with the complexity of the cannabis businesses over here. There's a lot of work that goes in between managing this business and putting those funds into this system. So this is what we do at Safe Harbor. We actually have, over the years, created our own internal software platform, And it's really all about BSA compliance and monitoring the companies at a higher level. And of course, that goes in conjunction with, say, your other types of anti-money laundering systems in the back office. We don't eliminate the Verifins or those systems in the back office. We complement them, and we extract data from them, and we extract data from our financial institution partners into our proprietary software in order to make sure our bankers don't miss anything. Because if you know, and many of you have been in the banking industry, you know, the path of least resistance is often the path taken by staff, and you can't do that in bank secrecy. So this platform allows us to make sure that we protect our bankers and service providers from missing any activities to keep them safe, as well as the financial institution. And then we work with this fintech platform. And if you kind of view this as a very high level online banking program, and our clients, once they're onboarded with the financial institution that we've selected, they work through this platform to issue commands or to issue directions through extraction files, through direct communication to the financial institution, who remains the money transmitter. So the way this looks to the regulator, if you're looking in how this works, is even at Partner Colorado, when we decoupled this out from under them in 2021, is the financial institution over here becomes responsible for the fintech platform and monitoring our activities. That means our activities have to align with their appetite on policies and procedures and how we manage the risk. So there's a lot of interaction between Safe Harbor and the financial institution, and back and forth. And even as we talk about lending, so how we deal with the lending aspect is we never put anything on the balance sheet of the financial institution that they don't have some comfort level. So we are talking to them completely, whether we have our own loan committee and then we have a joint loan committee with the financial institution. We underwrite to their risk level, to their risk appetite, and they monitor very closely everything we do to underwrite that risk. So it's not just we like this loan, we're going to put it on the books, and you don't have any say into it. That's why when people say, do we want to go out there and have 20 financial institutions, that doesn't work to our benefit, because managing 20 financial institution relationships to that complexity, to that detail, is too much work for a fintech model. So the best opportunity is to get those larger financial institutions who are willing to put the time and effort into managing a fintech platform. And the financial institutions that we are finding who are coming to the table to speak with us are those that have actually focused on managing fintech relationships already. Whether or not it has to do with cannabis is just another risk that they're learning with our assistance, but it is that they have already learned to utilize their core system with a fintech platform to service the final industry. So when we're talking about, and this will be probably more interesting to the investors on the phone, is how does Safe Harbor make money in this model? So the first thing we talked about was the KYC, knowing your customer. And I see some advertisements often out there that say, well, you can get your account opened in 2 days. Well, I would sure like to know how they're learning a complex multi-state operator inside of 2 days and booking 45 accounts inside of 2 days, because these multi-state operators do come with 10 to 15 to 20 to 25 accounts. And if you know the KYC aspect, you need to know how the money flows between those accounts, what each of those accounts are for. And then you take into consideration the way they've had to separate their assets in terms of trying to legally protect themselves from any federal actions against any one part of their company or one state. They have what we would consider in BSA a lot of shell activity that you need to understand in those ancillary accounts and how they work together. So the complexity of KYC, I would say it will take an average of probably 2 weeks. And the biggest problem we find in KYC is the beneficial ownership issues. There are still a lot of investors in the cannabis companies that do not want to be known as investors. So this is where we really start it, and we collect onboarding fees. And then we actually, once we have the account open with the bank, we collect monthly compliance fees to an average of $500 to $700 per account per month. And what do those really cover? When you consider we're monitoring nearly 1,000 accounts and we're filing nearly 1,000 reports, that's a lot of the compliance work, is regular monitoring, regular touching base with the companies, and then, of course, monitoring the funds, knowing that the funds that we're putting into the financial system over here are not illicit. Or if, of course, we find illicit funds, that we're working with the financial institution and law enforcement to actually take action on that. So then we get investment income on the deposits. So if we have, $200 million to do with financial institution, it didn't used to make much difference when it was 25 basis points, but now that we're, close to 5% there, or approximately 5% at the Federal Reserve, we're actually earning interest on that. And then we are loaning out a percentage of our deposits with a financial institution and actually earning origination, servicing, and interest income on those loans. And we've created a very detailed process in terms of understanding the risks and lending in and out of itself. And then what we do is we fee share back with the financial institution based upon the number of activities and services that we actually have with them. So that's how the fintech works. And that's why financial institutions will actually continue to move into it. So I'll get past, you can see those things online in terms of how we're developing our income strategies. But I wanted to just kind of talk about, the regulatory environment. This is right now the platform that we are taking money from over 40 different states across the country and managing that through courier systems at this point in time, and getting it to the Federal Reserve, working with those couriers, crediting the accounts through each of those financial institutions. So you can again see that it doesn't behoove us to have 25 different financial institutions, but to have a few very solid relationships, because the complexity of getting those Federal Reserve accounts and getting couriers access to those Federal Reserve accounts and getting those reports and working with our clients on a remote basis across the country can get very complex. And the fewer the relationships, sometimes the better it is to manage. In terms of regulations, I'm just going to take this off at this point in time and stop sharing. In terms of regulations and safe banking and where that's going to go, deregulation, and whether it will really increase banking, I think based upon the BSA risk, you're going to see a lot of financial institutions continue to shy away. I think what you see in this fintech model, or separating the business, and we've seen some financial institutions go more and more to this, because if you're a $30 billion bank and you're mixing that cannabis risk in with, and you got $1 billion in deposits and services, and you mix that $1 billion in with your entire financial institution and not manage it separately, you become subject to a lot of scrutiny of the entire $30 billion versus separating that. I think that descheduling completely is still a ways down the road. And I think that has a lot to do with law enforcement. It won't change the fact that this business has a lot of illicit activity still in it, trying to operate in plain sight alongside the legitimate businesses. So there's a lot that has to be sorted out there, and banking, as I said, will do that. I think the cash intensive nature is going to be continually there, just like you see in liquor stores or tobacco shops or casinos. I think the younger generation may push it the other way, but one of the largest growing markets, fastest growing market, is still your baby boomers. And a lot of them don't ever want to use any type of record where it shows that they're buying cannabis or marijuana on their debit or Visa card. And if you go back to the fact that there was a situation where some people couldn't cross the border from Canada to here because they had debit cards that actually showed cannabis transactions, that keeps a lot of people shy away from actually using any major credit card or debit card. So the record isn't quite there. And I think you're going to see that long term, just as you still see that in a lot of the liquor stores. I think that the opportunity for financial institutions to consider banking is going to come out of the Safer Banking Act, should that actually move into formalized legislation. And I think that gives everybody a chance to actually determine whether they want to take that risk on. But again, I'll go back to the fact that many financial institutions don't want to serve money service businesses. So, if you increase that complexity with a high level of illicit activity out there, I think that a lot of financial institutions will still shy away and not want to manage that complexity. The last thing I'll say is that will the largest of financial institutions move into this? I think it's still going to be more regional and community, because the fact of the matter is, if you have 1,000 branch offices across the country and your staff at those branches is about growth and managing growth, and opportunity to open cannabis accounts is a great opportunity, how do you manage monitoring your BSA activities in 1,000 branches? It's a very complex situation. And I think that that's why the fintech model has actually worked for us, and has worked even though it evolved to that model, it worked for us from the beginning, because we were doing it remotely as the companies grew across state, and we were growing with them. And I think that was probably the smart thing that we did. But then it said, how do we, we believed it should have gone into a for-profit out from under a credit union environment situation. And that's why we ended up decoupling it and moving it outside. And I would say that even the regulators at Partner Colorado Credit Union, when we decoupled, I think they felt relief, not only because we were segmenting that risk with expertise, but because the development of a program and to stand up that program, to manage that program, took too much strategic development time away from the board and officers and management to actually develop what we were really supposed to be doing at the consumer and community levels. At this point, I want to open up for questions and see if there are any questions.
Great. Thank you so much. Very informative in an area that is just very new. I'll combine, there are some questions coming in. I'll combine a few here. Can you comment on who your partner banks are? And I'll add to that question, how scalable is your business? How many banks, given your current structure, could you take on?
Well, we don't necessarily discuss who they are because we're under NDA. And if you think about it at the same time, a lot of financial institutions don't necessarily want to be known. It's like I have a career of like 38 years as a banker, and the only thing they're ever going to remember me for is cannabis, right? So a lot of these banks don't necessarily want to go to the forefront of being known as the cannabis bank. So while there are certain reporting requirements on the bank side with regulators that this has to be disclosed in certain areas, we don't necessarily disclose our bank. Now, we have had banks actually disclose themselves in their communities to let their communities know that they were doing it. But even then, they don't want to necessarily open the door for everybody to come in the door. They want it managed very systematically and methodically through us as a third party, even putting their referrals through us so that it's going through a methodical. They don't want them actually going into the branches and just saying, I want to open a cannabis account. So that's why we're very quiet about them. As far as the number of banks, right now, as I said, once we decoupled this out from under Partner Colorado Credit Union, put it in a for-profit and a public environment, we are finding that the regional $10 billion size financial institutions are coming to the table to discuss. But again, they have a specialty in working with fintechs and integrating fintech models into their core system. And this is a very big process. So it's very important to get a solid relationship, mostly about the fintech model than the cannabis model. The cannabis is an education process, but the access that they have to get into the lending environment, because we all know as financial institutions, that's one of the most valuable relationships that we have with our clients long-term, that they have to deal with the actual depository side one way or another. So we make the depository side a little easier for them so that they can really get access to some of that good lending that we're seeing in the industry. So I would say I don't intend to probably look for more than 5, and it will be service-based and fintech specialized based. So when I talk about service, this industry has a lot of issues in terms of getting access to major credit cards or international transactions. And just as we've seen them move to a national platform, we see them now looking at international opportunities at the same time. So those extra services and being able to implement that type of service to the industry will make a difference in terms of how we select partners in the future.
Great. Another question that popped in here is regarding lending and receiving interest on loans. Who is doing the lending and credit underwriting? Are you doing that, or is the respective financial institution? And are all the loans cannabis related?
Yes, all loans are cannabis related. And, they not only just licensed related, but what you find are a lot of leasebacks to the cannabis company with somebody who specializes in managing those properties. So sometimes we'll have one company, one company with whom we're doing business, but they have 5 cannabis shops. 5 different locations. So, we find some very good, solid underwriting when we're dealing it that way. We do the initial origination, the interviews, the collection of information. And before we even get to term sheet, we're talking with the financial institution with whom we want to place this loan. And we're saying, here's everything we're seeing. We think this is a good loan for these reasons. Are you comfortable issuing a term sheet? And so it's a joint effort. I apologize. Long day of travel yesterday. So we do it jointly.
Okay, so here is relating to first, do you think the safe banking bill in Congress now will pass next year? And I guess related to that, if it does, will big compliance and software companies like Jack Henry, Fiserv, et cetera, come in to offer the compliance? And does that hurt your competitive position?
I think some form will pass next year. And my reasoning isn't necessarily because of the need. It's because it's an election year. I believe at some point in time it has to be addressed. And as we know, everything in Washington is incremental. And I think SAFER offers an incremental path forward, as does the consideration of rescheduling. The industry is never going to get everything it wants all out front. I think it's taken the industry a long time to actually organize sufficiently to actually lobby in DC to get what they need. But what they have done correctly is they work with the financial institutions very closely in their lobbying so that the regulators feel very comfortable. When I helped Senator Craple's office a while back on safe banking, his office was concerned about financial institutions doing one thing, jumping in haphazardly, not knowing what they're looking at, and not protecting the financial system. And how do we do that? So there's a lot of legislation that they're trying to make sure that we still protect the financial system while legislation assists with the actual cannabis ability to get banking. Did I answer that fully?
I think so. Yeah. Okay. Now the other question is the competitors. If it passes, are all the bigger compliance and software companies all just going to jump right in?
Okay, so if I were to give you my personal opinion on this, there are a lot of companies who have developed over the last 9 years, while this market has been growing, who have developed these compliance packages. And I don't believe that someone like a Jack Henry is going to go out there and perhaps develop their entire new package for cannabis banking. Now, as I said, it does relate to a lot of money service banking. So those who have developed platforms for money service businesses may then expand into cannabis, but I think there are options for them to partner or, to actually purchase other companies who have developed the full platform for cannabis. So I really think that's what's going to happen. Just as I see financial institutions that when legalization does happen in the next 5 to 10 years, they may want to just go out there and purchase it versus build it. There's a big difference. I think there's a lot of pent-up interest in the market, but legalization, I think, is one of the actual triggers that's going to change a lot of things.
So there may be an exit for you, not in the sort of banking sense, but perhaps in the more consulting sense. I guess related to that, somebody had asked here, you have your credit union relationship. do you foresee, and I know this is something you probably can't talk too much about, or maybe you don't know, what is their thoughts at the credit union about keeping their ownership stake?
Oh, yes. Well, if you had followed the transaction through, the SPAC environment and the de-SPAC environment went south in that year when we finally finished. We were really actually supposed to be posted on the NASDAQ much earlier, but there was a lot of education process because of the cannabis aspect. So it took another 3 or 4 months to actually educate NASDAQ to the point that they were comfortable with listing us. And during that time, and the de-SPAC process became very complex, and we ended up with that debt on our back. And consequently, the Partner Colorado Credit Union ownership position became a greater position than they wanted to. They are holding a great deal of ownership at this point in time. I don't think it's their long-term plan. They are a not-for-profit entity, which means long-term, there may need to be some divesting of some of that stock, because a lot of that stock, like the restructure that was also in here, they took additional stock as an owner. They have a great interest in us. If you remember, I was the CEO of Partner Colorado for 20 years. They know us very intimately. They know what we're doing. It's their baby as much as it was my baby in terms of launching. So it is a very, very close relationship with a mutual benefit to both of us to succeed in the long term. So I will say that just as they helped create this program and launch it from 2014 until now, you will consider that strong partnership will work to our benefit of both us and their ownership position long term.
Well, to keep to the schedule, I think we have to move on. We could probably talk all morning about the subject. We really appreciate you taking the time to share your thoughts and about this new industry with us. There are some other questions that will get forwarded to you, but thank you so much, and especially you're really doing a duty coming back from vacation, hitting it on the first day. So I appreciate that.
Yeah, thank you. And I don't know if last night's election results in Ohio changes your maps at all, but I think
it will.
Right. But good to see. But great. Thank you very much.
Well, thank you for having me. And if anybody needs to reach out directly, feel free to do so.
Fantastic. Thank you.
Appreciate it.